Hi, my name is Dean Gonzalez.
And I'm Simone Talawi.
We're doing our two-company comparative analysis on Spirit Airlines Incorporated
and JetBlue Airways Corporation.
Hope you guys enjoy our presentation.
The major holders of Spirit Airways Incorporated are the Vanguard Group with a little over 6%, Lone Pine Capital LLC with a little bit over 5.5%, and Jennison Associates with 5%. Some of the top holders of JetBlue Airways Corporation include Dimensional Fund Advisors with 8.5%, Prime Cap Management Company with 7.5%, and Vanguard Group with almost 6%. Notably, both JetBlue Airways Corporation and Spirit Airlines Incorporated share quite a few top institutional holders as their investors. Fidelity Growth Company Fund, Vanguard, and BlackRock are a few names that we see here as owners in both companies. It is very customary to see a significant number of common shareholders of sizable publicly traded corporations.
The company's capital structure is arguably one of the most important choices. From a technical perspective, the capital structure is defined as carefully balanced between equity and debt that a business uses to finance its assets, day-to-day operations, and future growth. It is important for a business to make enough of profits to cover the cost of capital. If not, investors and lenders may not be attracted to the corporation due to the belief that they won't receive a sufficient return. There are advantages and disadvantages to using debt in a company's capital structure. If the company is not judicious with their financing methods and procedures, the stockholders will perceive the company as a risky investment and be put off from investing into the company. Another point worth mentioning is how the time value of money comes into play when borrowing funds. $1 million that is borrowed in today's market has a higher value than $1 million that could be earned by the companies over the next few years and used for capital. Due to inflation and interest rates, it can be more beneficial for a company to borrow funds to use expansion of projects that could start adding significant value to the company. Borrowing funds can be a powerful tool for companies to use to their advantage. Cost of debt can be described as the effective rate that a company pays on its current debt. With that said, Spirit Airlines Incorporated's cost of debt post-tax is 0%, while JetBlue Airways Corporation's cost of debt post-tax is 3.47%, meaning on every dollar of debt, JetBlue's Airways is paying 3.47% more than Spirit.
Cost of equity is the return that stockholders receive when they invest into a company. For Spirit, the cost of equity comes out to 14.375%. JetBlue Airways' cost of equity comes out to 5.145%. Spirit is paying out a higher amount of return to their stockholders, showing that they're a little bit more of a risky investment than JetBlue would be.
Cost of capital can be defined as the cost of funds used for financing a business. Cost of capital depends on the mode of financing used. It refers to the cost of equity if the business is financed solely through equity, or to the cost of debt if it is financed solely through debt. Most companies use a combination of debt and equity to finance their business, and for such companies, their overall cost of capital is derived from a weighted average cost of capital. Spirit's weighted average cost of capital, also known as the WACC, comes up to 14.9%, while JetBlue's WACC came out to 4.11%. Showing that Spirit's weighted average cost of capital is higher by a total of 10%.
Spirit Airways Incorporated has a debt-to-equity ratio of 0%. The optimal level does not increase or decrease because they don't offer dividends to their shareholders. The WACC currently is 12.03%, and the optimal level is 12.04%. This in turn would decrease their enterprise value from $5,516,834,998 to $5,509,760,450. This would also cause a decrease in their value per share of 10 cents. JetBlue Airways Corporation has a debt-to-equity ratio of 47.97% currently. Their optimal level is 90%. This would decrease their WACC from 3.11% to 2.51%. This would also increase their enterprise value from $1,050,416,300 to $1,185,431,407. Their value per share would also increase. It's currently at 16.72, and it would increase to 19.84.
From the results presented on JetBlue's analysis, an increase in the current debt-to-equity ratio shows that it could significantly increase the company's value of JetBlue. If they chose to increase the debt ratio to 90%, they could acquire a gain in their total enterprise value that would come out to $1,185,431,407, according to this analysis. The net gain for JetBlue's value would be $135,015,107. This analysis suggests that Spirit should not increase their debt-to-equity ratio for their company. According to this analysis, it does not show a net gain on enterprise for Spirit Airways.
In general, a higher debt-to-equity ratio means that the company has been aggressive with their financing and debt. In the case that JetBlue decided to increase their debt to the optimal level, this could definitely benefit them in some ways. On the other hand, increasing their debt could decrease their bond ratings as well as lower their ability to implement large projects to grow their company. Spirit Airways could possibly restructure their company financially by issuing bonds since they currently do not have any issued. In comparison to the companies we chose, Southwest Airlines has a much higher market cap than JetBlue and Spirit. JetBlue has a heavier long-term debt-to-equity weight in comparison to Spirit Airlines, and JetBlue also has a much higher percentage of long-term assets as compared to the other companies. Alaska has a market cap of $8.84 billion, which is about twice as large as JetBlue's at $4.83 billion, yet they have a similar capital structure but have a lower percentage of long-term assets. Spirit's capital structure is more equity-based than the other airlines because they do not issue out dividends to their stockholders. This is why they have such a high percentage of cash and shareholders' equity in comparison to the other competitors.
JetBlue's stock price closing value December 31st, 2014 was $15.86 per share, which is lower than the value generated from our fair value analysis of $17.26 per share. This suggests that the stock price is slightly undervalued by $1.40 in JetBlue's case. Spirit Airlines Incorporated closing price valued December 31st, 2014 was $75.58 per share, which is higher than the value generated from our fair value analysis of $45.14 per share. This suggests that Spirit stock is slightly overvalued by the market by $30.44. Given with these two numbers, as far as investment goes, JetBlue's case would be undervalued by $1.40, showing a potential of growth, while Spirit Airlines' overvalue of $30.44 shows a potential of declining in their stock price.
That concludes our presentation. Thank you all for watching. I hope you enjoyed it. Have a great night.